Let's get the global picture out of the way. Mark Matthews of Bank Julius Baer and Company is joining us right now. Mark, great to have you back in the program. Thanks very much. Just a quick word on what we're seeing in the U.S. And I'm talking about one particular sort of yield spread, the difference between the 2 and the 10-year, which has steepened recently by some almost 28, 30 basis points since it made a low in mid-August. Some are reading that to mean that maybe expectations are kind of veering to the fact that perhaps we'll actually have a soft landing. Things will not get as bad in the U.S. on the growth front. Do you really think that is the case? That's how we should read this indicator? This is the 2 minus 10?
Well, I can't comment specifically on that spread. I'm sorry. I wasn't aware of it widening the way you said, but I would generally concur with the idea that we will avoid a recession. Our own models suggest that. The Federal Reserve's models suggest that. And various economic data shows that the U.S. economy is actually in pretty good shape. I think first and foremost, the one to cite is the fact there's 11 million job openings, which is something like twice the number of people who are unemployed and actively looking for work. So if we do have a recession, I think it would be extremely mild because of that huge pent-up demand for labor. But also, the consumer sentiment surveys look like they're turning around a little bit. The University of Michigan one was reported recently. Long-winded answer to your question, I don't think there will be a recession in the United States, and therefore the fixed income market should reflect that.
Mark, good morning. The Indian market has been charting its own territory, its own charts, right? We are very close to all-time highs, and we've seen quite a bit of buying by foreigners as well. What's leading to this massive decoupling?
It's not just India. Brazil's up 15% year to date in dollars. Singapore is in positive territory. So is Indonesia. There's several, Asian/emerging markets that are actually attracting a lot of inflows. And I can't precisely say why, because the dollar has been such a big headwind. But what I would say is if the dollar is actually reversing course now, then I think that these emerging markets could really take off. I guess perhaps one thing is that their inflation rates are low compared to the West. India's inflation is lower than that of Germany or the United States because it never did all of that huge stimulus in 2020 and 2021. And so they don't have, they're not coming off of a sugar high the same way the West is. I think people are looking for alternatives because they realize the big technology-driven, US-driven bull market of the last decade is over. And we don't know entirely what the new market will look like, but we're starting to see little green shoots here and there, including in emerging markets. And my sense is that the emerging markets, excluding China, are going to outperform in the coming 1 or 2 years, including India.
Well, that has happened already, right, Mark? I mean, since the last time you were here with us in the studio, the market has had a huge surge. I mean, it's been a rally across the board, whether it's in financials, it's in mid-caps, and now we're hitting psychological levels as well on the upside. What is your thought on how the Indian markets could move from here? Would you put incremental money to work now, expecting a big rally post the Fed meeting, purely because India has been outperforming on account of better macros? Or are you still a bit cautious?
Actually, I would respond in the positive to your question. I would. I think India is poised to go up a lot. And the reason is that what kept the market buoyant over the last year or so was local buying. And the local buying is still there through the SIPs. And I feel that locals realize there's a virtuous economic cycle in India. They can see it with their own eyes. It's the foreigners now who are starting to come to India. And I think they're just beginning to come into it. And I think to reiterate what I said earlier, people are looking for things outside of technology, outside of the U.S. They're looking for green shoots around the world. Where will the leadership come from? And India is down 5% in dollar terms, I think. But it's positive in local currency terms, and if the dollar starts going down, it will be positive in dollar terms too. And it'll join that little collection of countries I told you, like Singapore and Indonesia and Brazil, for example, of countries that are actually up year to date. And that just naturally attracts attention in a sea of red to see some green.
Mark, the other bit has been, the conflict, right? Russia and Ukraine, and there's a spate of articles, etc., would suggest that there are things are turning around there, and Ukrainian forces are reclaiming many important cities. Any thoughts on that? What's going on there? I don't know if you've looked at it. What could be the implications if that were to continue?
The market seems to be interpreting the big Ukrainian advance in a positive way. I don't think it is. What we want is for Russia to have peace with honor. Otherwise, it's very dangerous. And I don't see this as something that moves toward peace with honor. It seems the Ukrainians are clearly emboldened, as they should be, by their advances and not willing to concede anything at the negotiating table to Russia, including Crimea. I think it makes the situation more dangerous, in fact.
More dangerous, in fact. So, Mark, sorry, getting back to India then, at some point, do you reckon that we run a risk of getting into some kind of bubble territory, if not already there? I mean, purely in terms of valuations, the premium is already at a record high compared to the emerging market peers.
Well, I think with the exception of the bottom of the global financial crisis, India always traded at a premium to emerging markets. There's a lot of different reasons for that. I'm not saying they're all merited, but it's the reality. And I think that the market can go up if earnings go up, and I think they will. And the expectation for earnings, we started the year looking at for about 25% earnings growth, and then that came down all the way to the low teens. But now I think the earnings revisions for India could start to recover again. And anyway, yes, I think that the market can go up. If the earnings go up, it will grow into the earnings.
Okay, well, the corporate profit to GDP ratio is now at a decadal high of 4.3% in India, so it's already improving quite a bit, the earnings picture. One more macro data point that's working in our favor, Mark, is the fall that we've seen in crude. Of course, this morning it's risen to $93 a barrel, but from the highs that we saw in July, the crude prices are down about 30%. I mean, the high was around $128 a barrel. Are you factoring that into your positive commentary on the Indian markets, or do you think there could be incremental upside because of that?
Well, our view was always that the oil price would come down, and so it was a difficult view to have when it was at $125 a barrel. But we still think that it should be about 75 12 months from now. And the biggest reason for that is, to quote the old commodity trader saying, the best cure for high prices is high prices. So what we've had is a very robust supply response. You're seeing it in Europe, by the way. The Europeans have bought so much natural gas and increased their storage that their natural gas price is down about 40% over the last 3 weeks. And gasoline prices in America are falling too. And so I think that that combination of a strong supply response, as well as there's no doubt some demand destruction that's been going on. A lot of factories in Europe, for example, have had to be shut down because they just couldn't make money with electricity prices so high. I do think that the market will continue to balance in favor of a lower price, as I said, about $75 12 months from now.